Welcome back. Today, I'm going to show how to estimate inventory using the gross profit method. Let's get started.
Okay, our company, their inventory was destroyed by fire on March 31st. And we have to estimate their ending inventory for the period. So let's do this. On January 1st, they had inventory of $220,500. They have purchases of $764,400. So with those two amounts, we get our goods available for sale. We have sales for the period of $882,000, and they normally have gross profit of 25%, which means 75% of those sales was the cost of goods sold portion. So we're just going to work through this. This is the gross profit method of estimating ending inventory. So our beginning inventory was $220,500. Our purchases were $764,400, which gives us goods available for sale of $984,900. Now, I want to calculate my sales revenue. My sales were $882,000. My gross profit is typically 25% of that. So I'm going to take that times 0.25, which means my gross profit is typically $222,500, which means my estimated cost of goods sold is just going to be sales minus, not equals sales minus profit. Gives me cost of goods sold of $661,500. I take that out of goods available for sale, which gives me estimated ending inventory of $323,400. That is my estimated ending inventory amount using the gross profit method. Again, that's a good way of estimating ending inventory when you don't want to go out and actually count the inventory yourself.
So that was estimating the inventory using the gross profit method when we're told the gross profit percentage on sales, which was 25%. Alternatively, we could be given, say, a markup percentage and then asked to calculate the same thing, the ending inventory, using a gross markup percentage, a markup percentage instead.
We'll assume markup percentage of 20%. Okay. All of this is largely going to stay the same, but our formula is going to be different. So we'll copy and paste that down there. This number right here is going to change. So we'll just go ahead and delete that number. These are formulas. Okay, so if our markup percentage is 20%, and that gets us to the sales revenue of $882,000. So here's our slide on it. So if we have the gross profit on selling price, we take that and 100 minus the gross profit on selling price, which is what we already did. Now we want to go the other way around. We want to know what the gross profit on the selling price is because we have the selling price of $882,000. So we want to calculate this percentage, the percentage markup on cost, which is 20%. And then we're going to take 100 plus 20%. So it is 20% divided by 120%. So the idea being, whatever our cost is, we're going to take our cost plus the markup is obviously the selling price. So this equals, inside the brackets is going to be the formula. So our 20% markup is going to be 0.20. That is going to be divided by 1.20, which is 1 plus the markup itself. So 1 plus 20 is 120. So our percentage, if I click that right there and blow this out, our percentage is actually 17%. So if we marked something up by 20%, it means that the gross profit is 17% of the sales value. So we just want to take that 17% and multiply it times our sales revenue, which gives us $147,000. So maybe I can, we'll do 20% divided by 20% plus 100% equals 17%. Okay, that's what we did over here in in the cell. So gross profit is 17% times $882,000 gives us $147,000. So our estimated cost of goods sold is now $732,000, and our estimated ending inventory, therefore, is $249,900.
That pretty much wraps up working through this problem on calculating ending inventory using the gross profit method, either whether we're given the gross profit percentage or the markup percentage. So have a great day. God bless.